Hi, I am Dr. Purushottama DN, Assistant Professor of Commerce. Let us begin with the session for Become Third Semester course, subject entitled Indian Financial System and topic entitled Significance of Financial Intermediaries. Financial intermediaries play an important role in the modern financial system and benefit the economy as a whole. They have some economic effects in the eyes of the role in the modern financial system. Number one is reducing hoarding. By bringing the ultimate lenders and the ultimate borrowers together, financial intermediaries reduce the hoarding of cash by the people under the mattress, as is commonly said. Number two is help the household sectors. The household sector relies on financial intermediaries for making profitable use of its surplus funds and also provide consumer credit loans, mortgage loans, etc. Thus, they promote savings and investment habits among the ordinary people. Number three is help the business sector. Financial intermediaries helps the financial business sector by financing it through loans, mortgage, purchase of bonds, sale, etc. They facilitate some investment plan, equipment and investments and inventories. Number four is help the state and local government. Financial intermediaries help the state and local bodies financially by purchasing their bonds. Number five, help the central government. Similarly, they buy and sell central government securities and thus they help the central government. And number six is lenders and financial intermediaries both earn. When savers deposit their funds with the financial intermediaries, they earn the interest. When financial intermediaries lend to ultimate borrowers, they earn the profit. In fact, the reward of the intermediation arises from the difference between the rate of return on the primary securities held by the financial intermediaries and the interest or dividend rate they pay on their indirect debt. Number seven is spread risk. Financial intermediaries possess greater resources than individual to bear and spread risk among different borrowers. This is because of their large size, diversification of their portfolios and economies of scale in portfolio management. They can employ skilled portfolio managers and other financial experts. They also benefit by the exploiting economies of scale in lending and borrowing. On the lending side, they can invest and manage investment in primary securities at unit cost for below the experience of the most individual lenders. Number eight is creation of new assets and liabilities. All financial intermediaries create financial assets. The banks create money when they purchase primary securities. Other intermediaries create various forms of non-monetary indirect assets when they deposit money. Non-financial spending units create primary securities. In each case, the financial asset is created by the purchase of another financial assets or by the purchase of intangible assets. Number nine is provide liquidity. Financial intermediaries provide liquidity when they convert an asset into cash easily and quickly without loss of value in terms of money. When financial intermediaries issue claims against themselves and supply funds, especially banks always try to maintain their liquidity. And number 10 is help in lowering interest rates. Competition among the financial institutions leads to lowering of interest rates. Financial intermediaries prepare to keep their savings with the financial intermediaries rather than in cash. The financial intermediaries in turn invest them in primary securities. Consequently, price of securities are bid off and interest rates fall. Number 11 is low interest rates benefit both savers and investors. When interest rates decline, both savers and investors benefit. First, the real cost of the lending to borrower are reduced. These in turn tend to reduce cost and price of goods and services. With the reduction in interest rates, the return on the time deposit also reduced, which induces savers to deposit their funds with the financial intermediaries. Even the later pay lower interest rates. Still, number 11 is bring stability in the capital market. Financial intermediaries deal in a variety of assets and liabilities which are mostly traded in the capital market. If there were no financial intermediaries, there would be frequent changes in the demand and supply of financial assets and their relative yield, thereby bringing instability in the capital market. Number 13 is benefit to the economy. Financial intermediaries are of immense help in the working of financial markets in executing monetary and credit policies of the central government as well as state government, and hence in the promoting the growth of an economy by transferring the funds from surplus to the deficit funds. Financial intermediaries create large financial assets and liabilities. They provide the economy with money supply and with near money assets. And next is role of financial intermediaries in the economic growth. Financial intermediaries, which consist of commercial banks, cooperative credit societies, mutual funds, mutual saving funds, saving and loan association, insurance companies, and other financial institutions, who are savers and ultimate borrowers who are investors. By performing this function, they discourage holding by the people, mobilize their savings, and lend them to investors. Investors can borrow funds internally by using their own savings and externally by using the savings of the others. Financial intermediaries provide external finance. Savers who or ultimate lenders deposit their savings with financial intermediaries, and financial intermediaries in turn lend these funds to ultimate borrowers. The difference between the lending and borrowing rates or the profits of the financial intermediaries. Financial intermediaries lend to borrowers by purchasing primary security issued the letter. These bonds, equities, mortgages, bills, etc. Financial intermediaries buy them with funds kept by the savers with them. Therefore, able to profit by this transformation process by the exploiting the economies of scale in lending and borrowing. On the lending side, the intermediaries can invest and manage investments in primary securities at unit cost far below the experience of most individual lenders. The large size of their portfolios permits a significant reduction in risk through diversification. They can minimize, they are favored with the tax benefits that are not available to the individual savers. On the borrowing side, with a large number of depositors, they can normally rely on predictable schedule of claims for repayment. Thus, financial intermediaries encourages saving and investment, which are essential for promoting economic growth. Thus, the role of the financial intermediaries. The growth of process is partly that the buying securities of one kind from borrowers and selling securities of another kind to lenders, and thereby contributes to an increasing in the willingness to save and document to invest. More importantly, they try to find out better investment opportunities and facilitate their exploitation by helping industries. Among the factors, investment depends upon the rate of interest. The lower the interest rate, the higher is the investment. Competition among the financial intermediaries for the primary securities raises their prices and lower the rate of interest. And moreover, when savers keep their cash holding with financial intermediaries, which involves less risk and are safe and liquid, the demand for money falls, which further lowers the interest rate. Role of financial intermediaries in underdeveloped countries. Financial intermediaries play a special role in the underdeveloped countries. In such countries, the capital market is unorganized and undeveloped. The majority of the people are poor and they cannot save. Those who save their investment saving in gold, jewelry, real estate, speculation, foreign exchange, and consumption. Under these circumstances, financial intermediaries undertake the risk of encourage the flow of personal savings from the unproductive to productive users. The encourage households to hold financial assets instead of the physical assets. To the extent households are willing to switch from the purchase of physical assets to financial assets to serve as their instruments of savings. Resources are released of development purpose. Further, as the economy develops, non-monetized sector is gradually transformed into the monetized sector. With the increase in the rate of modernization of the economy, the banking habits of the people also grow. In such a situation, the commercial banks alone are not sufficient to mobilize savings and put them into productive channel. So the role of financial intermediaries becomes all the more important in the mobilizing and investing these investments for capital formation and economic development. The growth of financial intermediaries in the course of development in such a countries helps in the economizing the use of money. These financial institutions grow. They sell indirect securities to savers. These securities are close substitute for money, so the savers buy securities instead of keeping money in cash. It is in this way these financial intermediaries help in the economizing the use of money, which in turn controls and the supply and the demand for goods and service from increasing. Thus, financial intermediaries helps the controlling inflation directly in underdeveloped countries. Number 4 is role of financial intermediaries in the saving investment process. Financial intermediaries transmit funds between savers who lend and investors who borrow. They mobilize savings and channel them into the hands of the investors who need more funds than they have on hand. In other words, they are conduits through which savers can lend their excess funds to investors. Financial intermediaries or commercial banks, cooperative banks, and insurance companies and other types of financial institutions, they act middlemen by the transferring the funds from savers to the investors. By lending their surplus funds, savers stand to gain because they earn the interest or dividend on their funds. On the other hand, investors stand to benefit, then they borrow to carry out their investment plans. Without financial intermediaries, savers would hold their surplus funds and investors would not carry out their investment plans except who can finance internally. The essential function of the financial intermediaries is to satisfy the simultaneous with the portfolio preference of both the savers and investors. Savers are ultimate lenders whose assets are bank deposits, insurance policies, pensions, etc. Investors are ultimate borrowers or non-financial units who wishes to expand their holdings, such as real assets as inventories, real estate, plant, equipment, etc. They finance these by issuing primary securities, which are bonds and cooperative equities, debts, individual and business mortgage bills, etc. These bills are liabilities. Financial intermediaries issue indirect or secondary security. They are currency demand and time deposit of commercial banks and saving deposits, insurance and pension funds of the non-financial intermediaries. Financial intermediaries between original savers and ultimate borrowers or investors. Savers deposit fund with financial intermediaries instead of the directly purchased bonds, mortgages or equities, and financial intermediaries in turn lend funds to ultimate borrowers. Financial intermediaries acquires primary securities issued by the ultimate borrowers, and in turn issue their own secondary securities for the portfolio of the ultimate lenders. In other words, investors sell securities to bank and issue newly created demand deposits in return in banks. These deposits are thus spent on the current output, ultimately accurate to the saver in the community as a financial asset. Investors also sell securities to non-banking financial intermediaries. These in turn sell client to themselves to the savers. Further, the technique of the intermediation get primary securities distributed efficiently from the ultimate borrowers to ultimate lenders and from lenders to another through dealers and securities exchanges. They tend to raise the level of savings and investment by purchasing the marginal utility of lost dealers' weight of financial assets to the lenders and reducing the marginal disutility of the lost dealers' worth of the debt to the borrower. They also tend to increase the efficiency of the resource allocation by the placing investment projects against the one another for lenders to the examine. Thus, the financial intermediaries are able to improve the efficient of distributive techniques of intermediation in many ways. Their role in the saving investment process is quite similar to that distributive techniques or techniques, lotteries or land sales. They enable investors to spend more efficiently. So, as we have seen, financial intermediaries have a key role to play in the world economy today. We are the lubricant that keep the economy money going. Due to the increased complexity of financial transaction, it becomes imperative for the financial intermediaries to keep reinventing themselves and cater to the diverse portfolios and needs of the investors. The financial intermediaries have a significant responsibilities towards the borrowers as well as the lenders. The very term intermediary would suggest that these institutions are pivotal to the working of the economy, and along with the monetary authorities how to ensure that credit reaches to the needy without delay the interest of the investors. This is one of the main challenges before them.